32.9%. That was the contraction of the United States economy during the second quarter of 2020. Now, that announcement combined with an unemployment rate of 11.1% and the highest bankruptcy rate since the financial crisis have caused the stock market to crash. Or not. In fact, over the last 4 months, the stock market has actually had one of its best 4-month periods in history. You heard that right. During the worst economic crisis of our lifetime, the stock market has seen some of the most rapid gains in history. Now, many people have attributed this strange behavior to special circumstances and a new kind of market and economy. Yet, some people are saying something different. In fact, there's a small percentage of investors that have seen this strange pattern a few times before. For example, in the year 1993, a new technology called web browsers started gaining popularity around the world. Now, these web browsers, or more specifically the Mosaic web browser, allowed for the average computer user to connect to the internet in a simple and straightforward manner for the first time in human history. And it was this technology that helped lead the expansion of the internet and the growth of computers throughout the 1990s. And this growth was so massive that from 1990 to 1997, the computer ownership rate more than doubled from 15% to 35%. And from 1995 to 1999, the number of internet users grew from just 15 million to over 260 million. Essentially, investors could feel the wave of a new economy coming forward. I mean, with upstart companies like Amazon selling books over the internet, and eBay selling almost anything else, investors became extremely excited at the prospects of a new type of economy. Now, if that wasn't enough, also during this time, we saw one of the biggest cuts to interest rates in history. From 1989 to 1993, interest rates fell from 9.8% to just 2.9%. And all this meant was that investors could access capital much easier than they could just 4 years prior. And the last cherry on top was that there was a significant tax reform in the year 1997, which cut taxes on capital gains. And it was these three factors that led to one of the craziest periods that the stock market has ever seen. And let's put into perspective how crazy this period was. So normally, if you invest in the stock market, you can typically expect a 5 to 10% return per year. But if you were an average investor and started investing in the stock market in October of 1990, you would have seen on average a rate of return of about 39% per year for the next 10 years. And if that wasn't enough, if you were to have invested heavily in the tech sector with an index like the Nasdaq, you would have seen on average returns of about 111.8% per year from 1990 up until the year 2000. Meaning that if you were to have invested $100,000 into the tech sector in 1990 and simply held your investments for about a decade, your portfolio would have been worth $1.1 million. But the thing is that this appreciation in the tech sector and the stock market as a whole wasn't really because there was an influx of new companies that were raking in billions of dollars of profits. It was mainly because there was an influx of new tech companies that got investors excited, but more importantly, there was an influx of new investment capital from the excitement of the new economy, along with low interest rates and tax cuts. So now one of the general metrics used to tell you how overvalued the stock market is a metric called the PE ratio. And what this does is it just compares the price of a stock to its earnings per share. Now, even though the value of a company is a lot more complex than a simple PE ratio, this metric still is a good general indicator for determining if a stock is overvalued. So, in 1990, the average PE ratio of the S&P 500 index was about 15. Which is pretty close to the average PE ratio for the last several decades. But after the influx of new capital that started flooding the stock market in the 1990s, the average PE ratio on the S&P 500 jumped up to just over 30. All this meant was that the average company had doubled its value in relation to its earnings or profits from the year 1990 to the year 2000. And during this time, it was very common to hear stories through family and friends, and through the mainstream news, of people getting very interested in investing and even day trading in the stock market to try and take advantage of these insane stock market gains. And one can't help but draw parallels to today. You see, if you were to just search on Google for the popularity of a search term like stock market investing, you will see that there are more than double the amount of searches for stock market investing on a daily basis today than there were on average for the previous 8 years. But also, when you think about how the United States cut interest rates to essentially 0% recently, how there were also major tax cuts in the last few years, how PE ratios nearly doubled in the past 6 years, and how there is a belief from investors that we are likely living in a new kind of stock market, one can't help but draw at least some parallels to what happened in the 1990s and what is happening today. However, obviously, it is worth mentioning that the market today is quite different from the market in the 1990s, in the sense that investors are looking to make money off of established companies this time around, versus investors investing heavily into companies with no profits in the 1990s. Plus, this time around, the Federal Reserve is doing everything it can to prevent the market from crashing, and in the 1990s, it was kind of a key reason why the market crashed in the first place. So I'm not saying that we are in a stock market bubble right now, but I am saying that it is very reasonable to believe that we could be in one. And here's one of the best ways to know if we are living in a bubble right now. So it goes like this. When there isn't a reasonable explanation as to why an asset is increasing in value at a much higher pace than normal, then there is a pretty good chance that it is because you are in a bubble. I mean, in the 1990s, we saw it in the stock market and mainly in the tech sector. In the 2000s, we saw it in the real estate market. And remember, in the 2000s, when it became significantly easier to get capital from banks and confidence in the real estate market was at an all-time high, real estate prices increased by over 35% from 2004 to 2007. And this wasn't because the average person got 35% richer or any other hard economic indicators backing up the 35% increase. It was because an asset bubble was being created. A more recent example was the Bitcoin bubble of 2017, where the price of Bitcoin increased by about 370% from September of 2017 to January of 2017, yet the utility and application of Bitcoin only increased by about 10 to 20% during that time. And by the way, all of these bubbles that I have mentioned so far have been predicted by Google Trends. Essentially, you can just go on to Google Trends and look for search volumes of assets, and if you see any sort of spike in the search volume of that asset, then it almost always correlates with a rapid increase in price, which sometimes turns into a bubble. And yes, there are a ton of other bubbles that have happened in the past 20 years. Now, one of the troubling things about this stock market is that even if you include the stock market crash that happened in March, there hasn't even been a slight decrease in the value of the stock market, meaning that despite the economy being in the worst shape in generations, the stock market is relatively booming compared to the economy. And even though the stock market has never been directly correlated with the health of an economy, it is at the very least supposed to be a derivative of the economy. And actually, I made a whole video about how sometimes economic sectors like the stock market and real estate can lag behind or be ahead of the rest of the economy in terms of its reactions. So if you're interested in what I call the economic waterfall effect, please feel free to check out that video on my channel. Now, one key thing that might point towards the stock market going through a correction or a crash soon is the action that banks are taking in order to prepare for a significant downturn in the market within the next 12 months. JP Morgan, for example, just had a record earnings report in its second quarter of this year, yet its stock fell. And that is because it announced it is setting aside a whopping $10.5 billion in cash to help mitigate any future downturn in the economy. In fact, the company said that there is an increasing uncertainty about the economy and the stock market going into the future, and that they expect to see nearly double-digit unemployment for the next 12 months. And if that were to happen, we could easily expect more defaults on real estate loans, small business loans, and corporate loans, all of which would be a big hit to the banks, which could in turn make the financial sector collapse in a similar fashion to how it collapsed in 2008. And if the financial sector were to collapse, well, the stock market would likely collapse as well, and here is why. Who do you think is the largest shareholder of the company Apple? Is it the co-founder Steve Wozniak? Or maybe Steve Jobs' family? Well, it's neither. Wozniak sold most of his stake in Apple decades ago, and Steve Jobs didn't own much of Apple stock either. In fact, Steve Jobs sold all but one of his shares in Apple in the 1980s and never became a billionaire through Apple. He actually became a billionaire for creating the company Pixar, and therefore eventually became the largest shareholder of Disney. And if you want to know more about that story, I actually made a whole video about that on my documentaries playlist, so feel free to check that out as well. So if the co-founders of Apple don't own Apple, then it must be the current CEO, Tim Cook. Well, it's not Tim Cook either. In fact, Tim Cook only owns about 0.02% of Apple. So, the largest shareholders of Apple are actually Vanguard, BlackRock, Berkshire Hathaway, and SSGA funds. These 4 investment companies own 1/4 of Apple, and 3 of these 4 companies are considered to be investment banks. All this means is that these investment banks have a disproportionate share in Apple, so if these banks were to experience a downturn, then they might consider selling off a large portion of their Apple share, which would cause the price of Apple to collapse. And this example of the banks secretly owning Apple applies to virtually every other company on the S&P 500. So, as soon as the banks go downhill, so will the stock market. And this was a similar trend to what we saw during the Great Depression. In fact, Jamie Dimon, who is the CEO of JP Morgan, actually came out and said that the recessionary part of this crisis is actually still down the road, meaning that one of the top investment bankers in the world expects the economy to be bad for quite a long time, and that might eventually reflect through the stock market. Now, saying all of this, we are in uncertain times. I mean, there is an election coming up, the Federal Reserve is doing everything it can to prevent the market from collapsing, and most major countries around the world are taking on an unfathomable amount of debt in order to try and prevent an economic crash, even if it means that the future economic growth will be significantly lower. These are truly strange times, and even though it may seem like the stock market is fine right now, it is quite possible that we are in the middle of a bubble right now as well, and we just don't know it. So let me know in the comments down below what you think. Anyways, if you want to see my next video, which will be out in a few days, please subscribe and hit that notification bell, as that would mean the world to me. And please leave a like and check out my documentaries playlist if you want to see more videos just like this. So make sure to click on my next video, and I will see you guys there in just a few seconds.